RMB and to experiment with interest rate liberalization. And since December 2013, regulators have issued a series of opinions and implementation rules, negative list, PDOC 30 rules, and so on to guide the legal practice. But this is just unfolding now. So the principles have been outlined, but the mechanisms are still being built up. But it's already true that a large number of foreign banks have registered for RMB accounts. I mean, I would fasten your seatbelt if I were you. I think this is going to really open up. And then also, just earlier this month, Shanghai and Hong Kong announced a new Stock Connect program to allow investors in these different locations to trade in each other's markets. So this Connect program allows up to 50 billion US from Hong Kong to the Shanghai Stock Exchange, and up to 40 billion in the other direction. China already has a QFII program to let qualified foreign institutional investors invest up to apparently 200 billion in Chinese securities in the Shanghai Stock Exchange. But interestingly, only 80 billion of that quota has been filled. And so, you know, it's a little bit of a question. Why so little? Why has there been so little foreign investment, even relative to the 200 billion that's allowed? It's an open question. Is it too much red tape? You know, you can get the money in, you can get the money back out. It's a little bit tricky. But then there's another issue, which is foreigners may be suspicious of the market, afraid of manipulation, afraid of insider trading, afraid of political manipulation, afraid of poor returns, basically. What our research shows, and so this is new research with my colleague Robert Whitelaw and our student From Xiaoguang Liu, what we found is that China's stock market, in fact, does not deserve its reputation as a casino. On the contrary, I mean, we got these data and we set about just measuring things, and I'm going to go through it with you in detail, but we were really quite surprised to find what we found. In particular, what we find is, A, it's an opportunity for higher returns for outsiders, but more broadly, because we're really thinking about growth, is that it's an important channel for economic growth. So the paper is on my website. It's called The Real Value of China's Stock Market. So we're thinking about its role in driving economic growth. And just as background, I mentioned before, the Shanghai and Shenzhen Stock Exchanges opened up in 1991. And since then, China's stock market's become one of the most important enterprise financing channels in China. Right, the banks serve the big SOEs very well, but if you're a smaller medium enterprise, you know, your best source of capital may be friends and family, you know, and these without much legal or disclosure regulation to, you know, secure any of that. It's all through relationships. But with the stock market, small firms can IPO and get capital that way. In fact, China's stock market now has the second largest trading volume in the world and the third largest market cap, almost 4 trillion. And so you can see that over the years, China's stock market has grown and now has almost over 2,500 firms traded. In 2013, the CSRC actually shut down IPOs for a while, and the IPOs opened back up in January, and so already there have been a number of new IPOs, although it's still tiny compared with the new shadow bank loans. But you can see that this is a picture taken from a report from Dragonomics that. It's the private firms. So both state-owned and state-controlled firms and also private firms have stocks listed on the stock exchange. The Shanghai Stock Exchange is more the large state-owned companies, and Shenzhen is more the small and medium enterprises and the really small stocks, like more like NASDAQ stuff. And you can see that it's the private firms that have really dominated the IPOs. So the view is that this IPO channel is a narrow but efficient funding channel, right? The money going in through this channel, people think that's the money that's planting the right trees. Well, I wonder what this does. There we go. Okay, wonderful. So there's a long literature in economics, finance, and accounting, which links three kind of key ideas. One is the idea of good legal and market institutions, good disclosure, property rights, creditor rights, and so on, to stock price informativeness about future profits. So a lot of times when people talk about, is the market a casino just driven by speculators, or is the stock market, are prices actually linked to the fundamental value of the firm? Are the stock prices informative? Do firms with higher expected future profits have higher stock prices, right? So is there a link between stock prices and future profits? And if they're informative, then there's a theory which suggests that in turn is going to lead to more efficient capital allocation and investment. So there's lots of pieces to that argument, and I'll spare you, an infinite amount of the academic literature on it. But some of the idea is, if you go through the IPO process, you have to go through all this auditing and disclosure, and that breaks down the information asymmetry and gets information to investors about firm prospects. There's this idea that, okay, so Jack Ma may be the world's expert on e-commerce, and he may know more than anybody else, but he doesn't know everything. There's information out there. The teenagers, those guys know stuff. They know how the mobile apps are going to be used. Local businesses know how they may use this platform. All kinds of people. There's information out there about how e-commerce is going to get used. And one idea is that if Jack Ma lists Alibaba on the stock exchange, say in the US, now investors have a way to trade and make profit if they can generate some information about Alibaba's prospects, right? Now they have some way to express their opinion and make profit. If they can buy, if they think the price is going to go up, they can sell if they think the price is going to go down. And then the act of trading on their information is going to bring that information into prices, drive prices up if there's good information, drive them down if there's bad information. So then if Jack Ma is thinking about, well, maybe I will acquire this mobile phone app. Oh, and then the stock price goes up. Oh, okay. Oh, investors like that too. Maybe they also know something that this is a good idea. Or maybe I'm going to acquire this thing, and then the price goes down. Stock market doesn't like that decision. So maybe he will, right? So now the idea is that managers can learn from the information, from the signals that they get in their stock prices, right? So this is kind of the economic theory behind this, that if prices are informative about future profits, that can in turn create signals and channel capital to the best places. If money is chasing the best profits, then it's going to be planting the right trees. So we look at stock price informativeness. So my colleagues, Timon Philippon and Alexei Savov, and their co-author Jenny Bai at the Federal Reserve have developed a model and a measure of price informativeness. Essentially, they're looking at a cross-sectional regression of future earnings on past prices. And they look at the explanatory power of this regression. Very simply, do firms that go on to have high profits, were those the ones that had high prices to start with? Or are prices just not informative, right? So a higher explanatory power is more informative prices. So they're looking at the US data, they have another fish to fry. We take this to the Chinese data. And what we find is, first of all, that the average level of, so we run this cross-sectional regression every year from 1996 to 2010. We look out 1 year ahead, 2 years ahead, 3 years ahead about how prices predict future profits. And what we find is that the average level of stock price informativeness in China is comparable to that in the US. In other words, stock prices in China are as informative about future profits as they are in the US. So this is the first sort of contradiction to the casino theory. The other thing is that we look at the trend of this informativeness over time, and we relate it to the regulatory innovations that are taking place. I mean, throughout this time, the CSRC and the Shanghai Stock Exchange have instituted all kinds of mechanisms, various reforms. There were some accounting frauds. Then China joined the WTO. National 9 rules were issued to strengthen minority shareholder rights and dividend policy. Margin trading and short selling began to be allowed so that people can express negative opinions, and these things have increased the price informativeness. Then it kind of dropped off a bit after the crisis for many possibly obvious reasons. So then the next thing we look at is, well, what about the efficiency of corporate investment? So for this is a different set of data altogether. We're looking at how stock prices react to information about new investment. And the idea is the investment must be efficient if stock prices go up when investors hear about some new investment taking place. And so we have this measure of the efficiency of investment. And what we were really quite surprised to see is that, so this is a measure of investment efficiency each year, and we plot that over time. And what we find is that the correlation between the informativeness of prices about future profits and the efficiency of investment is really quite high. The patterns, we got left scale is price informativeness, right scale is investment efficiency, and these things are highly correlated over time. So this is consistent with the idea that stock price informativeness is associated with higher efficiency of investment. Right? You think just to compare for a moment, a bank also has information, but it's not information aggregated across a diffusion of investors. The bank may know a lot about a company. It may have somebody sitting on the board. It may have a lot of inside information about a company, but it's a different kind of information than the information that's impounded in publicly traded securities. The other thing we look at is just how Chinese investors price stocks. And so, how do they discount profits? What kind of return do they require? What kind of risk premium do they require to compensate them for different kinds of risks? So, just as has been done for decades with the US stock return data, we go and we look at what's called the cross-section of expected returns. Which firms have higher returns and which firms have lower returns? So higher returns may be compensating investors for risks that they don't like. Another way of saying it is, if a firm has a higher required return, investors are discounting its profits more, its price will be lower. Conversely, if returns are lower, that means investors are paying up for that kind of a return profile. So what we find is actually the cross-sectional patterns of returns in China are quite similar to those in the US. And this is quite surprising because remember, China's a closed market. It's not like US and Chinese investors are investing in each other's stocks and they're somehow blending together. Their real economies are blending together through exports and imports, but their financial systems are not. These are, they're a different set of people trading a different set of companies. But surprisingly, what we find is just like US investors, Chinese investors pay up for large firms. They bid those prices up. Those larger firms have lower expected returns than small firms. They pay up for so-called growth stocks. They pay up for liquid stocks, and the liquidity premium is pretty high, which is not surprising if you think that illiquidity may also be reflecting a lot of asymmetric information, which there may be a lot of in China. They pay up for long shot returns, so firms that have high previous maximum. We don't even have a theory of why anybody would do that. It's just like, it's a behavioral thing. You just like stocks if you think there's just a big right tail event. If you think there's a possibility of really hitting the lottery with that stock, you'll pay up for that. And so then you actually expect a lower expected return. Chinese investors like it just as much as the US, whatever, it's a universal truth. Something else that's interesting we found is stocks that have higher state ownership seem to be discounted. They have higher expected returns, higher average returns. So that's interesting. I mean, there's all kinds of theories and who knows which way the sign would go, but one view is with a state-owned enterprise, you have an additional risk, political risk. There's uncertainty about what exactly that political privilege is going to be. Will it continue? Will it be taken away? It's just another dimension of risk, and it appears that Chinese investors discount for that a little bit. We looked at how China's markets, and we not only look at the market portfolio, but also at the sort of standard, let's think of them as hedge funds. These are risk factors, but they're constructed by taking portfolios, say, small stocks minus large stocks, or growth stocks, value stocks minus growth stocks, winners minus losers. So these portfolios have been formed with US stocks, and people have thought about what kinds of special returns they offer. So we looked at these four sort of factor portfolios. In China, we constructed them, and also we looked at them, those same stock portfolios in the US, Europe, and Japan. And it's well known that the US, Europe, and Japan, these are open markets, and their correlations with each other are quite high. But China's correlation with these other markets, China's portfolios, their market portfolio, their size portfolio, their book-to-market portfolio, their momentum portfolio, China's portfolios have very low correlation with the other markets. Not surprisingly, it's a segmented market. In addition, from 1995 to 2012, our sample period, we found that China's markets actually performed very well. So during the period, the average US return was 9.4%. We find that the Chinese stock market earned 17% over that period. Some of that's just appreciation of yuan, these are USD returns, but a lot of it's driven by the Shenzhen stocks, the small and medium enterprises, which have done better than the large stocks. So then when we take that good average, now average performance doesn't necessarily mean that's an opportunity or not, because you have to adjust for the risk of that return. This is financial theory. So to look at that, here you have high returns, and China's got very low correlation with other markets. So if you thought about an investor, let's say a US investor or a global investor looking for an investment opportunity, and let's say it's a US investor, and their opportunity set is more or less spanned by the standard US factors that we think of as being priced. If we then said, well, what would happen for that investor if they added the Chinese market to their portfolio? And the way that we quantify that is through something called the alpha. And so if a new stock or a new investment has a positive alpha, the idea is that if you add that to your portfolio, it will improve the mean variance profile, meaning it will either increase the mean or reduce the variance. And so it's a good thing. And what we're finding basically is that these China portfolios, the market, and these size and book-to-market hedge funds essentially have have significantly high alphas for US investors. In other words, foreign investors would do well to add these Chinese portfolios to their portfolio, to invest in China. And this is actually completely consistent with research by Peter Henry, dean of the Stern School, also very long and distinguished economist, who's got all kinds of work looking at emerging markets and looking at markets that have opened up their stock markets to foreign investment. And his work suggests that if you open the doors and foreign investors can come in to try to capture these high alphas, that will drive prices up. It will lower the cost of capital for Chinese firms. It will boost investment, boost wages, and boost economic growth. So what's going to happen with the Shanghai-Hong Kong Connect program? We don't know yet. If foreign investors are spooked by China, I mean, our research says they should take another look because there's some nice returns there. Or maybe this is the beginning, maybe money will start to flow in, and as they further open the doors, this may bring the stock market up. I mean, China's worried about money flowing out, and it should, right? Domestic investors should also invest beyond borders as well. This is the idea of diversification. You should see Chinese investors trying to get a piece of the S&P 500, US investors trying to get a piece of the Chinese stock market. You should have global risk sharing. There's no reason to keep these two markets in bubbles away from each other. They should blend. What this is suggesting is there's just as much good, if not more, from letting foreign capital in as letting domestic capital out. So just to summarize our conclusions, contrary to the casino theory, we find that stock prices in China are as informative about future profits as they are in the US. Moreover, the trend in stock price informativeness over time is highly correlated with the trend in corporate investment efficiency. Though it's a segmented market, China's stocks exhibit pricing patterns similar to those in US markets, in developed markets. So like US investors, Chinese investors pay up for large stocks, they pay up for growth, they discount small stocks, they pay up for growth stocks, they discount value stocks, they pay up for liquid stocks, they heavily discount illiquid stocks, and they pay up for long shots. So the market has performed well, and its low correlation with other markets creates opportunities, i.e. high alpha, for global investors. But that high alpha, the other side of the coin of that, is a high cost of capital for China's firms. And so continued reforms, continued opening up the market, continued Shanghai Stock Exchange market reforms that increase informativeness should further empower China's stock market to attract capital, allocate it efficiently, and support economic growth worldwide.
Thank you so much, Professor Jennifer, for giving us this impressive and valuable speeches. Okay, right now, let us move to our next part, the panel discussion. We are pleased to welcome 5 guest speakers who will present their ideas about today's market. But before we start, could please our another guest speakers, Mr. Zheng from Credit Suisse. Yeah. Okay. Thank you for all the guest speakers. Right now, let us begin our panel discussion.
Okay, so welcome everybody, and my name is Kevin Chen. So I'm the moderator for the panel discussion tonight. And first, I really appreciate the panelists to join us for tonight. And I'd like to introduce them one by one. Of course, due to the time limit, I will not give the complete bio of each of them, but I will give some brief introduction. So the first panelist from the left-hand side from me is Mr. Xiaoguang. So he is a veteran in Wall Street, has been the managing director at Morgan Stanley, Deutsche Bank for many years, decades, and also currently is running a hedge fund in New York. So that's Xiaoguang. Thank you. And the next gentleman next to him is Mr. Zheng Meola. So he's a partner at a large accounting and advisory firm, and more than 30 years experience in the accounting, asset planning, etc. So later on we will be able to have the opportunity to hear from him about the view, I guess, on the finance side of investment. And the next speaker is Mr. C.K. Zheng. So he's a managing director at Credit Suisse, and more than 10 years at Credit Suisse, and before that he was the executive director at Morgan Stanley. And so we will welcome his input to the discussion tonight. And the fourth panelist here is Mr. YiDu. So he is in fact a representative for a Chinese pharmaceutical company based in the U.S. So he will give us some insights about I would say the investment from the Chinese firms in the U.S. And a couple of words about myself. So I currently work for a hedge fund, formerly worked for a couple of investment banks, and also I teach at some universities here as a professor. So let's start with some prepared questions, and later on we'll open to the audience for tonight. So I guess we'll start with the first question. I guess for Mr. Xiaoguang. So tonight the topic is about the U.S. and China, China and U.S. investment forum. So what's your economic outlook for China? Is it booming or some crisis coming, or what's your view?
Thank you. That's a very broad question.
You can turn on the speakers off. Yes.
Hello? Okay, great. So thank you for asking me a very, very broad question. So, quite frankly, I've been having a kind of on this issue, right? I always believe it's not just because you guys probably heard there are a lot of people who are very, very bearish about Chinese economic growth, the outlook, the potential direction. So I was actually in a unique camp, I would say, on this particular topic. I actually am a strong believer of all the bear cases made for Chinese economic potential, because I want to maybe establish a bearish case first, and I'll talk about why maybe my conclusion could be different from a lot of these bears. Purely from the economic structure point of view, I actually, almost from a few years ago, I firmly believe that the way the Chinese economy was organized, which is driven by export and also by investment, that approach was able to take advantage of a lot of large expanding financial markets as we can offer in the US and in Europe. So a lot of China potential growth, when one can really export to other countries, is can use the foreign reserve approach to use this foreign, let's say, U.S. Financial system almost like a saving place. So that approach, though, totally stopped in 2008. So from that point of view, a lot of this, it has a feedback loop, right? So I mean, of course, it takes a while to elaborate on all the details to elaborate why when we got into financial problems, the U.S. really was the originator of the problem, but yet it bears very little consequence for that. So of course, as we discuss that, we're going to talk about much deeper questions about how the global financial system play a very, very important role in terms of both sometimes supporting the economic growth and sometimes really play a negative force against economic growth. So, so back to the issue of China. So first, I was very bearish with the potential Chinese growth potential. But just because of that bearishness of Chinese growth potential, and also I'm very, very bearish about the China's financial system status. For example, Professor Carpenter used some interesting chart. I was trying to refer to that. Some interesting note is that China is a bank-driven economy, right? The Chinese credit is very large versus other places. But that actually is a very, very important point. I know it's probably very hard to establish that firmly all at once. I want to maybe mention that when you look at the financial system, the way I look at that, I look at it almost like an inverse pyramid. So at the core of the financial system is a very little reserve. For example, all the Federal Reserve can control how much reserve they can really use at the bottom. And that can be through the banking regulation or through reserve control. It can become somewhat like the credit that can issue the bank. Now from there, of course, there's a bigger market such as bond market or stock market. And from there is also shadow banking. And on top of that, there is derivative. So when you put each layer on top of each other, the financial market, again, is a gigantic system. But between each layer, there's really this degree of support by credit. This degree of the support by the financial system's sophistication. So the reason I link up the economic issue in China and the financial system issue in China is because China was really, on one hand, need to go through a very rapid economic reform to change the structure of the economy. On the other hand, in order to make that happen, China had to reform the financial system very strongly. So I think probably I'll establish, I'm taking way too much time by now, but what I'm trying to say is on one hand, I'm kind of believe China had to go through a very, very painful economic structure process. But because China need and realize that need to reform the financial system at the same time, so I think the two things in combination in a very good way will work out to be a very strong way. So to make a long story short, I believe that China's reform is hitting the right note. The reforming the financial system to some degree relate to what Professor Carpenter raised the issue earlier. I think my point on that was even a larger one. I think China will become a very important financial player. Even though I'm not purely measuring purely from the size of Chinese stock market, not alone. I'm talking about China's connection with international marketplace. That is going to be a very, very important force in the future. So I think the global financial system is decisively shifting into China's favor in the next couple of years. So I have been, in fact, because of what the bearishness I need for China, I have in fact been a perennial bear for Chinese market for a very long time. Almost every time I go to Beijing or Shanghai, I tell people, if market goes up, just sell it. Because there's no foundation for this market to go up. That's basically what I've been saying that. However, I believe, starting from about a year ago, I believe almost all the reforms China put in place are hitting the right note. So I actually believe there is a very, very, very strong case to be made. A bottom will be reached somewhere this year, or maybe at latest next year. Well, we have a very strong bull market. That's my overall summary. Even though I didn't hit all the details, because I know I'm going to take way too much time. I can elaborate on those a little later.
So thank you, Mr. Very detailed answer, but not definitely bearish or bullish case, but I think really insightful. So next question, I guess we'll ask Mr. Jack Meola. So I guess you are very experienced in the corporate tax, pension planning, etc. So So what's your view or your advice for those Chinese companies who are coming to the U.S., establishing joint ventures, establishing investment entities? What's your advice for them?
Well, my advice to the Chinese companies that come to the U.S. that want to do business here is that the system is very different. What we have here is a long-established rule that when you're in the U.S., if you're a U.S. taxpayer, you are subject to worldwide income being taxed. Your assets are, and things such as sales, where those sales take place, may have a different effect. Now, the laws in China have changed over the years from a standpoint of getting now a little bit more like the rest of the world. The enforcement now is starting to take place in the corporate environment. What's even more interesting is the persons who are creating these companies that are in China are actually looking to become more part of the world. And if they come to the U.S., there's planning at the individual ownership level. What is now being entertained in China is the opening up of the use of trust, something that we've long established here in the United States, and we use it for estate planning purposes, for aid to family members. There's an innumerable number of ways and reasons that we set up trust. This is now being entertained in the China market. So people coming to the U.S., businesses coming to the U.S. are properly planned. And although it's a cultural difference, I must admit, more sophisticated Chinese who are coming here are becoming more adept at, okay, we have a different system, how do I plan for it? Can I use trust? How do I set up those trusts? That is becoming the more predominant methodology. Now, the idea of having a Chinese corporation and a U.S. corporation and running operations 24/7 has become so much more prevalent than, of course, 10